Is there real progress in this economy right now? I know we can look at these numbers and find some modicum of stability, but is there real progress, real growth?
Well, this is also a very important question, Romain, because if we think about what was the reason why we had a slowdown over the summer, it was likely because of the turmoil that came after Liberation Day. But Liberation Day is now 8-9 months ago, and things are gradually getting better on the trade front. At least there's more clarity, and we've, of course, signed a number of trade deals over the last several months. All those things at least means that uncertainty has been coming down. And at the same time, the one big beautiful bill next year, according to the Congressional Budget Office, is going to lift GDP by almost a full percentage point. So if I combine lower degree of uncertainty and at the same time some fiscal stimulus coming in the next several months, then we will also begin to see the economy reaccelerate as we go into 2026. So the bottom line is we should expect the labor market to bottom out at where we are now and then things to get better as we go into next year.
Torsten, I want to talk about what I continue to see as a bit of a disparity between what we're seeing in the official data and what we see in some of the sentiment indicators, and as well as a lot of the anecdotal evidence, including what we're getting out of the Fed Beige Book. The idea that a lot of folks on the ground, they're still going into the grocery store, going into retail stores, and in their view, still seeing higher prices, and they're still concerned about why they haven't come down. And I am curious as to when that becomes a concern for economists like yourselves, and more importantly, for the White House and Congress.
And this is, of course, very important, Romain, because if you think about that question from a macro perspective, it is exactly the question of when will the upper leg of the K no longer be able to drive things fast enough, and when will the lower leg of the K begin to become such a big problem that it begins to have a more heavy macro impact. And it is very clear in the sentiment data, exactly as you're highlighting, that things have not been particularly good on a number of different fronts. And it is also clear, as you're highlighting, that affordability in so many different ways is weighing on the sentiment outlook overall. But we still look at the incoming macro data, such as the employment report today is still very good.
Right.
Look at jobless claims. People are still having jobs. They're not getting unemployed. And at the same time, inflation is still too high. The Fed really has no other choice than to stay on hold in December.
Well, that's where I want to go. When it comes to inflation being very stubborn, it's not moving down. It's kind of clear that rates at this level aren't the cure for inflation and bringing prices under control, Torsten. So at this point, what do you think it will take?
Well, and that's why, of course, this debate at the FOMC is just, fascinating, that there seems to be a group of individuals who are very data dependent and looking at the incoming data. And the incoming data, which we've been talking about here, is basically telling us we should not be cutting. And then there's a different group of individuals who are saying, well, on the other hand, we have at the same time that we have a measure of R star, which is model dependent. And that measure of R star, you could argue, some people think it should be higher, some people should be lower. But some people hang their hat on a model. Other people hang their hat on the incoming data.
Yeah.
And I do think that the incoming data should get the most weight. And incoming data that's been getting today, jobless claims, non-farm payrolls, it does say that we should still be very cautious with cutting rates in this environment.